Still going live. Okay, we are live now. Hello, everyone's have the power to predict the economic slowdown or recession 1 year, at least 1 year in advance. So, in order to understand if there will be a recession or a slowdown, we must understand what are bonds. Now, bonds are debt instruments from a perspective of a company. Let me just explain you. If a company needs money, it can raise money in different forms, and bonds are one of those forms. Uh, Bonds are basically contract papers uh, which are sold by a company or a government. So let's take the example of the company. The company will sell this contract to anyone who wants to buy it, and in exchange for buying this contract, the company will pay interest and return the amount after the maturity. A lot of complicated terms, isn't it? Let me give you an example. Suppose the company wants to raise 1,000 rupees, let's say. It will issue 10 bonds of 100 rupees each, and it will float that bond in the market. People will buy it, 10 different people buy it, and these people pay 100 rupees each to the company, and the company promises them to pay 5 rupees every year as a coupon payment. And after the completion of 10 years or 5 years or 1 year, whatever be the maturity period of the bond, this maturity period will be written on that piece of paper, the contract. Okay. So after this maturity period, the company will return all that 1,000 rupees to the people who had bought the bond. So it's that simple. So what happened? Did you see? First, the company needs money, therefore it raises bonds. It gets 1,000 rupees, and for the next 5 or 10 years, it keeps on paying 50 rupees, 5 into 10, 50 rupees each. And at the end of 5 years, company had expected that it will use this money to grow its business and increase its profits, and using that profit it will later pay off the debt. Okay, so this is bond. This is how companies raise money. And bonds are also a mechanism by which governments raise money. Governments need a lot of money, right? How does it raise money? Government raises money by government gets money by tax. It taxes people. It charges tax to businesses. It charges GST. It charges personal tax, income tax, corporate tax, everything. That is one source, and the other source is issuing bonds. Right? Not a lot of people are aware of it because it's not a very popular market in India. But bonds are being traded. Government needs money; it raises it through bonds. Okay, so these are bonds, and bonds can have different validities. A bond that could mature in 1 year, there could be a bond which matures in 5 years, there could be a bond which matures in 10 years. So it goes up to 30 years. So the 30-year validity bonds are called long-term bonds, and the 1 year, 2 year, 3 year, these bonds are called short-term bonds. Now, think about something. If uh, a company issues a bond for 30 years, should it pay more interest? Or should it pay more interest on a bond which has a maturity of 1 year? So the company has to pay interest, right? In which case the company should pay more interest. So the answer is the company should pay more interest on the bond, which is more riskier, right? You have heard the term high risk, high reward, right? If there is higher risk, if there is higher risk, the company should be paying higher interest. It's obvious. Now, where will the risk be higher? In a 1 year bond or in a 30-year bond? Of course, it will be higher in 30-year bond. Why? Because you'll have to understand the kind of risk that is involved here. The risk is the company might not pay coupons or might not return the par value at the end of maturity. This is the risk, and longer it keeps the money, bigger the risk becomes. Just tell me something. Uh, you have two friends. One of them has asked you 1,000 rupees for 1 year, and the other person, he has asked the money for 30 years. Whom will you give money to? Of course, 1,000 years. Where do you find lesser risk? Of course, the one friend who is asking money just for 1 year. The person who is asking money for 30 years, I don't know if he will survive for 30 years. He may die. Yeah, right. So that this is the similar case with companies. The company might go bankrupt. The company might extinguish. The company might die. So 30 years bonds are risky, and therefore interest rates for those 30-year bonds are high. And since these 1 year bonds, 2 year bonds, they are not much risky, therefore the interest rates on these bonds are low. So this was the concept of bond. And in the next video, I'll tell you how can you use the prices and interest rates of the bonds to predict if uh, there's going to be a recession or not. Stay tuned. Next video will be out soon, and thanks for watching this video.